The capital asset pricing model, CAPM, is a model used to determine a theoretically appropriate required rate of return of an asset to make decisions about adding assets to a well-diversified portfolio. The model takes into account the asset's sensitivity to non-diversifiable risk, known as systematic risk or market risk, often represented by the quantity beta in financial industry, as well as the expected return of the market and the expected return of a theoretical risk-free asset. CAPM assumes a particular form of utility functions in which only first and second moments matter. That is, the risk is measured by variance, for example, a quadratic utility, or alternatively asset returns whose probability distributions are completely described by the first two moments, for example the normal distribution and zero transaction costs, necessary for diversification to get rid of all idiosyncratic risk. Under these conditions, CAPM shows that the cost of equity capital is determined only by beta, despite it failing numerous empirical tests and existence of more modern approaches to asset pricing and portfolio selection, such as arbitrage pricing theory and Merton's portfolio problem. The CAPM still remains popular due to its simplicity and utility in a variety of situations. The CAPM assumes that risk-return profile of a portfolio can be optimized. An optimal portfolio displays the lowest possible level of risk for its level of return. Additionally, since each additional asset introduced into a portfolio further diversifies the portfolio, the optimal portfolio must comprise every asset, assuming no trading costs with each asset valuated to achieve the above, assuming that any asset is infinitely divisible. All such optimal portfolios, i.e. one for each level of return, comprise the efficient frontier. Because the unsystematic risk is diversifiable, the total risk of a portfolio can be viewed as beta.